QQQ dropped harder, but bounced back faster, recovering over 3 months quicker than IUSG despite a deeper crash. One fund chases maximum gains with wild swings, the other keeps things steady with lower fees. And what's your risk tolerance? But here's where it gets interesting. Returns are where it really counts. Let's see which fund actually put more money in your pocket over time. Let's zoom in on this. QQQ's 2.3% gain over 3 months shows steady momentum. Nothing explosive, but it's heading into 2026 with positive traction. IUSG pulled ahead with a 2.5% gain in Q4. Not a huge margin, but every edge counts in this race. Here's where the story takes a turn. Over the past year, QQQ and IUSG delivered identical 22% returns. Two completely different strategies, same exact outcome. In plain English, one-year returns tell you how both ETFs performed over the exact same time frame, like race cars crossing the finish line together. Same track, same conditions, perfectly comparable results. But here's where it gets interesting. IUSG's 139% 3-year return is serious wealth-building momentum, the kind of compounding performance that transforms portfolios quickly. Now for the real question. QQQ's 135% 3-year return nearly matches its competitor. Just 4 percentage points separate these two tech powerhouses in this growth showdown. Let's dig into the details. QQQ's massive 102% 5-year return proves time horizon is everything. Patient investors get rewarded when volatility smooths out over time. Here's where things get revealing. IUSG's 97% 5-year return trails QQQ by 5 points. Solid growth, but doesn't quite match the tech-heavy benchmark's performance. In plain English, here's your winner-takes-all moment. IUSG dominates the 3-year race, but QQQ flips the script at 5 years. Your investment timeline isn't just important, it's everything in this matchup. But wait, there's more to the story. Raw returns only tell half the story. Sharpe ratios reveal which fund actually delivers better bang for your risk buck. Here's the thing though. Both funds deliver identical risk-adjusted returns at 0.8. They're equally efficient at converting volatility into gains right now. Let's take a closer look. QQQ's Sharpe ratio of 1.4 means you're getting solid returns without taking on crazy risk. That's impressive for a growth fund. Now, here's where it gets tricky. IUSG's Sharpe ratio of 1.3 shows solid risk-adjusted returns, nearly matching QQQ's efficiency, despite slightly trailing behind overall. In plain English, think of the Sharpe ratio like an amplifier knob. Turn up the risk, and you get more return. QQQ's amplifier cranks just a bit louder, giving you better bang for your buck. Let's see how this plays out. Volatility isn't just a number. It's the price you pay in stress and sleepless nights when your portfolio starts swinging wildly. Here's what really matters. QQQ's 23% volatility means wilder swings both ways. Bigger gains in bull markets, but steeper crashes when tech turns south. Now let's connect the dots. IUSG's 21% volatility is 2 percentage points lower than competitors. That translates to meaningfully smoother returns for your portfolio. In plain English, think of volatility like a roller coaster. QQQ's got wilder swings with sharper drops and steeper climbs, while IUSG gives you the thrill without the stomach-dropping moments. All right, pause here. Who's your pick? QQQ or IUSG? Drop your vote now. Here's the key takeaway. Sortino ratios cut through the noise. They show you which fund protects your money when things go south, not just overall swings. Now let's flip the script. Both funds match at 1.1 on Sortino. They're handling downside risk equally well over this one-year stretch. It's a dead heat. But there's a catch. QQQ's 1.9 Sortino ratio means it's delivering solid returns while keeping your downside risk surprisingly tight over 3 years. Let's get into the weeds here. IUSG's Sortino ratio hits 1.7, solid downside protection, but QQQ's still got a slightly better shield at 1.9. In plain English, the Sortino ratio measures downside protection. And here's the storm brewing analogy. Both QQQ and our ETF shelter you well during market hurricanes. But QQQ's walls are just slightly thicker. But here's where it gets interesting. Maximum drawdown reveals your true risk tolerance. It's that brutal paper loss you'll face when everything's crashing down around you. Let's zoom in on this. QQQ's 35% crash means watching your 100 grand drop to 65,000. That's the reality of tech concentration risk right there. Let's zoom in on this. IUSG's 32% max drawdown shows it weathered the storm better. Those 3 percentage points of cushion really matter when markets crash. In plain English, maximum drawdown shows us the worst-case scenario. QQQ crumbled slightly harder than IUSG when markets tanked, but both lost significant value. Think of it like watching 2 buildings collapse. One just kept a bit more structure intact. Let's break this down further. Recovery speed separates the winners from the losers. Every day you're underwater is a test of conviction and opportunity cost. Meanwhile, over a year to recover from a 35% crash. That's the real cost of volatility you'll feel in your gut. Now for the real question. IUSG took 504 days to climb back from a 32% drop, nearly 100 days longer than deeper losses typically need. Here's where the story takes a turn. IUSG wins on shorter returns with 139% over 3 years. But QQQ's better risk ratios and slightly smaller 32% drawdown show it handles volatility more efficiently overall. In plain English, here's the recovery story in marathon terms. IUSG stumbled less but took forever to bounce back. QQQ, it face-planted harder but sprinted to recovery way faster. Let's talk worst-case scenarios here. We're about to see just how painful a single year can get for these funds. But wait, there's more to this story. QQQ's worst year saw a brutal 42% loss. That's watching nearly half your investment disappear in just 12 months. Here's the thing, though. IUSG's worst year saw a 39% drop, marginally better than some, but still a painful hit that'd test any investor's resolve. In plain English, when markets get rough, QQQ weathered slightly bigger storms than most. Both funds got battered in their worst years, but neither sank completely. They stayed afloat through the turbulence. Now here's where it gets tricky. Fees look harmless at first, but they silently compound over decades, draining wealth you'll never recover. Every basis point counts. But that's not the whole picture. QQQ's cost is incredibly low at 0.2% annually. Just $20 per 10,000 invested. That's tough to beat. Let's see how this plays out. IUSG's 0.04% expense ratio means you're paying just $4 per 10,000 invested. That's 80% cheaper than QQQ. Here's what really matters. That $16 annual difference doesn't sound like much, but compounded over 30 years, and you're talking serious money left on the table. In plain English, couch change adds up faster than you think. QQQ's quarter versus IUSG's nickel seems trivial today. But compound that difference over 20 or 30 years, and you're looking at real money. But hold on a second. Concentration risk shapes your entire portfolio. Fewer stocks means you're placing bigger, riskier bets on each individual company's performance. Let's unpack this a bit. QQQ keeps it tight with just 102 holdings. It's laser-focused on Nasdaq's biggest growth names, no filler stocks here. Here's the key takeaway. IUSG spreads across 463 holdings. That's 4 times more diversified than QQQ's concentrated approach. More stocks means less single company risk. In plain English, QQQ concentrates your bet across 102 companies, while IUSG spreads risk across 463. Think of it like the egg basket analogy. If one stock cracks, IUSG barely notices. But there's a catch. Both funds are doubling down on tech growth stocks. That's what's driving their wild swings and tight correlation together. Let's get into the weeds here. QQQ's heavily concentrated in tech at 53%, meaning your portfolio's fate rides almost entirely on one sector's performance. Now let's shift gears and look at IUSG's 48% tech allocation is slightly more balanced than some rivals, but you're still betting heavily on one sector here. But here's where it gets interesting. QQQ's 53% tech weight versus IUSG's 48% explains the volatility gap. That extra 5% tech amplifies every swing up or down. In plain English, QQQ's tech slice is bigger than most growth funds. Think of it like cutting a larger piece from the pizza. You'll get more flavor when tech's hot, but brace for extra spice when it's not. Let's break this down further. QQQ wins the risk game here. Better Sharpe and Sortino ratios mean you're getting stronger returns with solid downside protection. Here's where the story takes a turn. IUSG wins where it counts. 80% lower fees and 361 more holdings means your money works harder with less drag. In plain English, think of it like race cars. QQQ's the high-octane sprinter chasing quick wins, while IUSG's built for the marathon. Different engines, different races, but both can get you to the finish line. But what about your time horizon makes the choice clear? QQQ for long runways, IUSG when you're closer to needing that cash. Now for the real question. QQQ's higher returns mean nothing if you sell during those brutal 35% drops. Your behavior determines whether QQQ's efficiency works for you. In plain English, so which dance partner's right for you? QQQ brings wild, aggressive swings, perfect if you're chasing big moves. IUSG, that's your steady, reliable partner who won't throw you off balance. Here's where things get revealing. Over 30 years, IUSG's lower 0.04% expense ratio saves you $50,000 compared to QQQ on a $1 million portfolio. In plain English, think of fees like race cars burning fuel. QQQ burns slightly more than IUSG each lap. A few extra drops per lap don't matter today, but over 100 laps, you've burned gallons more. But wait, there's more to this story. QQQ's for thrill seekers with long timelines who can handle 42% crashes, while IUSG offers gentler 39% drops with broader diversification. In plain English, here's your final takeaway. QQQ's the turbocharged sports car for thrill seekers who can stomach sharp turns, while IUSG's the high-performance sedan for investors wanting speed with smoother rides. Let's take a closer look. Standard legal disclaimer. Do your own research and consult professionals before investing. Now, for the real question. That's a wrap on our ETF breakdown. Hit subscribe if you want more data-driven analysis dropping weekly, just like this.